Hello, guys. So, quick announcement. I'm still grading the exam, so I haven't done yet. But the results are not quite good so far. So I was hoping you will do better. But still, there is a hope. So, okay, so let me share the slide and start the today's lecture.
Good morning.
Morning.
Before we start, I've got a question about the previous topic. So, could you please open the fifth lecture, the 11th slide, please?
Okay, wait a minute. What is the question?
So, the question is, we obtain the 14th formula using the assumption of equality of cross elasticities, right?
So this is the symmetricity of Slutsky matrix.
By the way, we can't see the slides.
I didn't share it. Okay, I can share it, but yeah. So I believe we have the same. So this is basically the symmetricity of Slutsky matrix.
Yeah. So the question is that symmetricity is always satisfied?
Yes. So if we believe that taxpayers behave according to the uh, utility function, so I don't even think that we need any assumptions about the properties of utility function. This can be checked. So what the existence of a utility function, if there exists, so we can check this when the symmetricity of Slutsky matrix is true, but it's a very general property. It's true almost, yeah, it's like if the preferences can be described, preference of consumers, right, can be described by a utility function. So then this Slutsky matrix is symmetric. So I think it's a so you can check my words and I can check it later. So I don't think we need any properties of utility function like continuity or probably it should be differential, so we can actually calculate take the derivatives, right, and do stuff like that. But that's all, no, like concavity or stuff like that. So it's a very general property.
So the 14th formula, so the final view of Ramsey formula, it's general, so it is assumed for every case, right?
Yeah.
Okay, because it wasn't
Yeah, so
obvious.
it's not a special case. It's
Okay.
just another way to rewrite the Ramsey formula. So it's a fact, it's interpretation, because we need to remember that Hicksian demand, it's a kind of a compensated demand, right? So it's like when utility is fixed at the initial level. So it's like fact. We need to remember this when we interpret this formula, but it's this the same. It's as general, right, as the first Ramsey formula we derived, but it's just another way to express it or reorganize it. Okay.
Okay, thank you. Now it is clear.
Mhm. Good. Okay, then let us move to slide 6. Okay, I shared it already. So then let me start recording. Okay. So I believe you see my slides for lecture 6 now, and today we move on and we will study income taxation, right? And more specifically, we will talk about optimal income taxation theory. So income tax is a tax which amount depend on the individual earnings, right? Basically on income. And the goals of the income taxes are the same as any other taxes, is to raise revenue and redistribute income. The two main questions when we study income taxation is how does income tax affect labor supply, right? Because it's on earnings, so what is affect labor supply? And then the next question that economists ask is what is the optimal design of income tax, right? So before we kind of start to address these questions, let us give some useful definitions. So usually the tax system, income tax system or schedule subdivide into three categories. Progressive tax, proportional tax, and regressive tax. The progressive tax is a tax imposed so that average tax rate increases as the taxable income increases. Right? The proportional tax is a tax imposed so that average tax rate does not change as the taxable income increases or decreases. And regressive tax is a tax imposed so that the average tax rate decreases as the taxable income increases, right? So this is how quickly the tax increases or decreases as the earnings, as the income of a person rises, right? So some examples of different tax schedule is, for example, Russia. Here, starting from 2001, we have a flat income tax schedule, so at rate 13. In US, they have a progressive tax with a bottom tax rate at 10%, and then it rises, and the top rate is almost 40% for incomes above 400 and something $1,000. Okay, so let me clarify what is average tax rate that we used in the definition in the slide above. So average tax rate is the ratio of the total amount of taxes to the taxable income, right? So basically taxes divided by income. And also another important tax rate that we will use is marginal tax rate. So what is marginal tax rate? It is the tax rate an individual would pay on one additional dollar of income. Marginal, as always, like marginal utility, marginal tax rate mean if we start on a point and increase just a little bit, so in this case increase the income of taxpayer just a little bit, what will be his tax rate? What will be his tax, right?
Excuse me. And one more time, how do we calculate average tax rate? So
Average tax rate, right? So if individuals earns, say, 50,000 rubles, then we calculate how much taxes he pays. It depends on the country, on the taxable system. So in Russia, it would be 13% of that income and divide by that income, right? The marginal tax rate is basically the derivative at the point, right? It's like how the tax rate change at this point, how tax change at this point. So it's a marginal tax rate. Okay.
Okay, and in case of flat taxes, as in Russia,
Yeah.
we won't see the difference between those proportions, right?
Right. So there's one little clarification that may be done. So when I described Russian tax system, I did not say about any deductions or transfers from the government, right? So if this is the end of the story, right? So that the income tax rate, so it's just 13% of the income, then it's just as simple. If we have a system where there is some transfers to people, right? Then, and so we describe that tax system as like it's more broadly, let's say this way, then it would be another story, right? But yes. So another important tax schedule is linear income tax. It's a very useful theoretical approximation. So, or like useful in theory tax schedule, right? So, what is it? The linear income tax is described by constant tax rate T and fixed transfer to everyone B. So the tax is equal to tax rate T multiply income Y minus B, where Y is taxable income, B is transfer, and it's often referred as a demo grant, right? Just for you to know. So we said that there are different tax schedules, like progressive, regressive, proportional. So then the question would be, how progressive should the tax system be, right? So this is a very important question that a lot of theoretical literature try to address. And to motivate our discussion of this question, let us consider optimal progressivity in a progressivity model, not even model, but just an example, considered in a way how the Edgeworth formulated the question, right? So let us assume for a moment that lump sum taxes are feasible. And let us just consider the following simple problem. Let us choose lump sum tax T1 and T2 to maximize the utility, the sum of utilities of two persons, U1 and U2. So it's as if we have an economy consisting of just two individuals, right? We want to maximize the utility, and to do that, we will choose the lump sum taxes T1 and T2. So we maximize U1 of that depends on Y1 minus T1 plus U2 that depends on Y2 minus T2, subject to a resource constraint that we don't collect taxes for any specific purposes only for redistribution, right? So this means that T1 plus T2 is equal to 0. One assumption on the utilities is they are identical and strictly concave, right? So then you can easily see that the first order condition for this case is the derivative of u1 is equal to the derivative of u2, and because utility is strictly concave, right? So the arguments should be equal. This means that u1 t minus t1 should be equal to y1 minus t1 should be equal to y2 minus t2. But what does it mean? It means perfect redistribution, that everybody have the same after-tax income. And this result is true for any number of individuals and even for infinite number of individuals, given the other assumptions we used. All right. Interesting, right? Because if we think what does this imply for the optimal tax system, it's actually in practice would imply 100% marginal tax rate, because if we in practice, right, in practice there is no lump sum taxes, but if we would want to achieve the perfect equalization of after-tax income, this could be done by 100% marginal tax rate, right? Which is kind of not that we observe actually in reality. So then what is the question would be, what is the key assumption behind this result, right? And of course, the key assumption here is lump sum taxes, or the other way to obtain this result is that assume that income is fixed, or that individuals do not adjust their income in response to taxation. This is, again, is not true in practice. And in practice, people can adjust their income. And in practice, we're concerned about the incentive effects of the tax system that impose high tax on people with high income and give transfers to people with low income. Right? So what we would expect is that any skilled person who earns high income, when he is charged with high income tax, has incentive to misrepresent her skill and to pretend to be unskilled to avoid paying high taxes, right? Because the system, like we described, would try to tax high income people and redistribute among all people, right? But then there's no incentive to work hard. So what we now see is that from the redistribution perspective, we want to redistribute income, right? We want to have high income taxes. But then we see a problem that if we impose high income taxes on people with high income, that people would just evade the income or misrepresent their skill and stuff like that, right? So we see
Excuse me,
the problem. Yes.
I've got a question. So, in the case, if a skilled person misrepresents his her skills, so in that case, he or she will receive a lower income, right?
Yeah.
So it's just the question of of let's say of the degree of tax. So at what point it will be more profitable for a skilled person to switch to be unskilled, let's say.
Yes, so you are right, and so our motivation was the goal of our motivation was to lead us to a question: what is the optimal level of progressivity or degree of progressivity, right? So how progressive should be tax, right? Because there is like two opposite effects, right? So on one hand side, we want to a higher level of progressivity from the redistribution point of view, but on the other hand, right? So we doesn't want to have a very progressive tax because it's produced a lot of what we will call it efficiency losses, right? Because high skilled people would have better incentives, right? So, and what is the main problem, right? It's actually informational problem that government faces, and because we assume, and this is actually more or less so in practice, that no way that government have no instruments or does not have power to make people reveal their types at no cost, right? No way to make people reveal their type at no cost. And certainly, right, the lump sum taxes cannot be imposed in practice as well. So with that, right, the government, right, so, and we have to live, and we will later consider a model that would try to trade off all these factors in order to kind of find the optimal progressivity of the income tax. So because skills cannot be revealed at no cost, income tax distort incentive and affect behavior, right? So income tax that is just a proportional, like not proportional, but income tax that depend on income, right? We will better understand this in a couple of slides. And so as I already said, an efficient taxation generates efficiency cost. And in reality, behavior responses to income taxes, they are large and heterogeneous. Right? So to be able later on to kind of have a kind of real model to address the question of optimal progressivity, we first start from modeling individual behavior. If we think about an individual, and that individual is characterized by some utility that depend on consumption X and labor capital L, and this utility functions U of XL, and assume that utility decreases in labor and increases in consumption, then the budget constraint is so that consumption X is equal to after-tax labor income, which is 1 minus tax rate T multiplied the wage rate multiplied the labor. And so individual maximize his utility subject to the budget constraint, and a solution to this maximization problem describe the behavior of the taxpayer. For us, it would be also helpful to consider an alternative representation of utility. So we can, instead of labor, use a variable z that is pre-tax income, and it's defined such so that z is equal to WL, right? And then utility function depend on x and z divided by w, right? It's just the same meaning, just a different representation. Sometimes it's useful to just work with that representation rather than with the first. So here I have two graphs that illustrate the solution to the individual problem, right? So you're well familiar with that type of graph. So this is a diagram where we have the budget line, and then the optimal solution is characterized by the point where an indifference curve is tangent to the budget line, right? So this point is x star and t minus l star again. So in this graph, the labor is denoted by different, like by little v, while in my formulas it's capital L. So this is because, right? So the figures are from the book Hendricks and Miles, and if I would use the little L in the formulas, that it would look a lot like I. So it wouldn't be very clear what letter is it, right? So for that reason, don't be confused, right? So what is what? So and the
Excuse me.
yes.
One more time. What is what?
So you see it's the x-axis is called leisure.
Yes.
Right. So then T is total amount of time that taxpayer has, that individual has. And then you see that T minus L star. What is it if the total is, if the axis is called leisure? This little L star is just labor.
Yes.
Right? That's it. I just was trying to explain why I have capital L here and little l here.
Okay. Now I get it.
Okay, good. So let's us now look at the right hand side diagram, right? It's the same diagram, but we now have pre-tax income, which is Z, on the x-axis. Right, on the horizontal axis, we have pre-tax income. Therefore, the budget line now looks, so it has the positive slope, but the essence is the same. The solution is described by a point where an indifference curve touches the budget line, right? And we have this point. We know what is how to describe the what that is described. That's its optimal solution of the individual, so we can calculate.
It's a pretty strange budget set because it is infinite on the right picture.
I think this is because WL, right? So we doesn't limit it anyhow, right? So if we put any assumptions on the WL, the wage rate, so then we could probably put some bounds on the pre-tax income. But without that, so if we assume that WL can be whatever, right, is just greater than zero, then yes, we would have line like that.
Okay.
So then we can analyze an effect of different variable changes, for example, an effect of wage increase. So if we consider the increase in the wage and what will happen in the left-hand side diagram, that right? So an increase in the wage would make the budget line more steeper, so it rotates in a clockwise manner, right? And the optimal solution move from point A to point C, and we can say that once that occur, there is a negative substitution effect on leisure, right? An increase in the wage rate would produce a negative, a negative substitution effect on leisure. And the income effect could be negative or positive, right? We cannot be sure without any additional assumption about the utility function. And altogether, so the effect of wage increase on leisure is uncertain, and this is mean that the effect of wage income on labor is uncertain, right? With the right-hand side diagram, so an increase in the tax rate doesn't affect the budget line, right? But it's affect the indifference curve, and check this by yourself later. The indifference curve becomes flatter, and as a result, the optimal solution moves from point A to point C. And as you can see from the graphs, this means that optimal pre-tax income increases as a result of wage rate increase. Okay, so this is just an example that we with this model, with this graphs, we can easily analyze the effects on the taxpayers' behavior of different change of different parameters like wage rate, tax rate. What is interesting? Yes.
And on the previous slide, on the right chart, why the graph just moved right? So
right again, which about pre-tax income, the right hand side or left?
Right.
So so to understand how the utility function, the indifference curves looks like, right? So what do we need? So this is our utility function u of x and zw, right? So how to draw the indifference curve? We need to equate it to some constant, right? And then express z as a function of or x, right? So it's x as a function of z.
Okay, but
right, and then yes.
But how did we made that conclusion without knowing the
So
current?
just so you see how w so if it's so just let's us think u of x and z divided by w is equal to constant. So now let's assume that w increases.
In that case, you will decrease.
Yeah,
Okay.
but to reach the same constant, right? So we will need to have a higher z.
Yes.
So let's now think about what does it mean about a graph. So because in different curves we always have the same. So now if x is the same, but z should be higher if w is higher, right? To so if you now will try to draw an indifference curve by putting points or dots, right? So then you will see that it would be flatter. Do you see what I say?
Okay. Yes.
Yeah,
I
just
get
try
it.
to
Okay.
draw it. Okay, no, it's certainly valid question. Just like you need to do it by hands to kind of feel the what does it mean. Okay, so let us now move on and discuss what is tax threshold. So we can consider an effect of introduction of a tax threshold into taxpayers' problem. So what is tax threshold? It's a threshold level income below which income is untaxed, or below which income is taxed at a different tax rate. So it puts a kink into the budget constraint. So here is a graphical illustration. You see on the left-hand side diagram that the budget line at some point kind of kicks, right? There is a change in the slope of the budget line. And this is because the tax rate at this point changes, right? So that it's, for example, in the area where letter A, near to letter A, the tax rate, say, is 0, but then after the dotted line, the tax rate increases, right? It becomes positive. Then the budget line would look like that. So why is it important? Because a number of people will concentrate at the king point, and this happens because an extra unit of labor will receive net pay of 1 minus TW, whereas the previous unit received just W, right? And this behavior is called bunching, bunch. People will bunch at point B, right? So what does it mean? It's now, right? Let's say we have not just one individual, just many individuals, and each individual choose its own optimal point on the budget line, right? Because budget line, if the wage rate is the same, the budget line would look the same for all such individuals, right? And then they choose their optimal solution depending on their preferences, right? So let's say people like A and C, they choose some point that is touches on that interval of the budget line, right? But people that are near point B, if as a threshold or kink in the budget line occurs, they now would prefer point B to nearby points, right? So I mean, in those people who was work a little bit more, but than this threshold level of income. But now each additional unit of income or labor that is above the threshold is charged much discontinuously more than the previous unit of income. And because of that, right, so they would now choose to kind of to sit exactly at this kink. I hope I managed to describe it more or less clearly. But this approach, I don't know about
Excuse me.
other. Yeah.
But doesn't it really depend on the utility function?
Yes, so it's like for some reasonable utility function, right? So if it's like, if we have an indifference curve looking more or less like that, so it's not really depend on the utility function. It's just yeah.
Okay.
If it's not some crazy utility function, right? But it's like what we assume, right? It's like more or less rational people. So then yes, this would be true that people would bunch at the kink point. Pretty general result.
Okay. So
pretty general, not result, but observation, I would say. Yes.
So most of our customers or citizens will try to be at point B, right?
Yes. Yes.
Okay.
So there are incentives to kind of concentrate on the kink point, and this is an important observation because most of the income tax schedule in real life that they have these features, right? Because tax rate does not change continuously. It's like, for example, I gave you as an example United States income tax schedule. So it's have intervals, and in this interval there's like different tax rate, like starting from 10%, then like something 20, then like 30, 40, right? And then it's at the end of the interval, it's change discontinuously, right? And if you will draw how the budget line looks like for in that case, it would have this feature. It would have kinks, several kinks.
Okay.
But why this is important? Because for points like A, C, we would have interior solutions, right? And a consumer at an interior solution respond to a change in tax rate continuously, right? But in a point like B, right, at the kink, we will have a corner solution, right? The utility functions is not targeted to the budget line, it just touches. And consumer at a corner solution may be left unaffected by a tax change, right? It depends on the tax change, but if the tax rate, say to the left of our kink would change a little bit, say a little bit decrease or a little bit increase, most of the people who were bunching at the kink point, they still would continue to bunch on the kink point. So they would be kind of unresponsive to change in the tax rate. But this is just a general observation for you to get familiar with that concept, and for us to kind of get some basic knowledge of how we can analyze the individual behavior. But with that, we can move on to the what we was preparing for is to consider a model of optimal income tax. This is now not a simple model, but a very serious model. It's a model of Mirrlees. And I would also let you know that Mirrlees received a Nobel Prize for basically this contribution. So he incorporated behavior responses into optimal income tax problem. So before we was kind of considered an individual, right? Here we will think of a case where there is an infinite number of individuals who differ in skill level S, and skill S is equal to wage rate. And skill S is distributed with some density function little f of S, right? So there is a number of people, they characterized by their skill, and skill is equal to a wage. An individual choose consumption and labor, or we can say, or pre-tax income, right? So we will use this way to formulate the maximization problem. So utilities depend on X and they divided by S, subject to the budget constraint, so that consumption X equal to the Z pre-tax income minus T of Z. T of Z, it's a very general function that describes income tax schedule, right? It could be linear, could be non-linear, it could be whatever. Yes, question?
I've got a question. Who is Z?
Z, it's like that variable. It's a notation, right, with which we worked. Is a pre-tax income. So it's just a notation, or just multiplication of W to wage rate and labor.
Okay, thank you.
You could alternatively formulate this model using labor, using L, rather than Z, right? But for the technical mathematical reasons, it's easy to do it this way, and Mirrlees did it in a way like that. So here is a graphical illustration. What is TZ? On a graph, it basically means the difference between the 45-degree line and the budget line, right? So it's the amount of tax collected for a given point of Z, right? For a given level of pre-tax income.
Excuse me. One more time. Which lines are there? So
the 45-degree line, you see, it's 45 degree in the low corner of the graph. It's just 45-degree line, and the other line is just some. So the key complication here is that we doesn't know what is T of Z. This is what, as I would say you later, we would be choosing, right? So the social planner is need to choose. But let's say he chose some tax schedule, TZ, and set it to imposed it on a taxpayer, right?
So
on a consumer. Then the consumer can calculate his budget line and choose his optimal solution point, right?
So can we
Yes.
say that the straight line is the line of the case when there is no taxes?
Yeah, that could be said.
Okay, and the other line, it's the case with taxes, right?
Yeah, right.
Okay, now it's okay.
Okay, good. So then we discussed already the tax base problem, right? So let us now formulate the government problem. As I said, the government chooses the tax schedule, so it chooses this function, TFZ, not just tax rate. It chooses like the whole function, right? To maximize social welfare function, which is some function W of U, and because we have different multiple individuals characterized by skill S, so we multiply this W of U by the density of skill, and then integrate this over integrate this by skill level, right? By S. And this is the social welfare function, right? So any questions about it? No? So it's W is needed to represent how basically what weights do we put on people with different utility level, with different income, right? But then there could be like the density function represents how many people with each skill level, right? And so we need to kind of put all this together to calculate the total social welfare function. Then the government is subject to resource constraint. It's basically that the amount of taxes should be greater or equal that some revenue requirement R. And to calculate the total amount of taxes, we need to integrate over S of TZ multiplied by this density function of S. And Z actually would be a function, right? So it's Z pre-tax income that consumer choose with skill level S. So so it would actually by itself be a function of skill S, right? But we don't write it here, so not to complicate our formulas. And then, right, so we also need to subject the maximization to individual first order condition. So let me read it and then explain it. So it's the individual first to consider in this case would be 1 minus the derivative of function t, and all this bracket multiply the derivative of u with respect to x plus the derivative of u with respect to L, multiply 1 divided by s, right? So this is because we write it's the derivative with respect to L, but to indicate that it's the second argument. But our second argument depends on g divided by f, so this is for we have 1 divided by s here, and all this should be equal to 0. These formulations differ from what we used in the, say, previous lecture, right? Here, right, so in the previous class when we analyzed the optimal consumption tax, right? How did we formulated the government maximization problem? We first derived the indirect utility function, right? And then used it, right, to formulate the government maximization problem. So the government was maximizing indirect utility function, or it could maximize some social welfare function that depend on indirect utility function. This is one approach, right? In this approach, right, so we don't derive the indirect utility function first, right? So you see it's just U here, just utility function. But what we do instead, we subject the utility maximization problem to individual first order condition, right? To ensure that we account for taxpayer behavior, right? Because what the taxpayer behavior is described by this first order condition, right? And once we are subject our maximization problem to it, we kind of guarantee that we account for its behavior. Do you see the difference? I hope so.
Would you please repeat the main idea? It's rather complicated for
Yeah, so
understanding.
it's not that simple. But what is an indirect utility function?
So
Or
it's the budget which depends on other parameters. If I'm
no,
right.
indirect utility function. How did we derive it? Right. So to derive indirect utility function, you need to solve consumers problems. Derive, say, X star and whatever. Right. In the previous lecture, remember what we
Yes.
did? We derived X star and that plugged in those X star into the utility function, so we get the indirect utility functions.
Yes.
So we already solved the consumer's problem,
Right.
And then we we kind of formulated the government problem based on this indirect utility function. Right? So what we want to show is that when the government choose its instrument, right? So the government choose tax rates, it affects consumers. So like we need to understand what effect it will produce on consumers in order to understand what instruments to choose. What instrument would be optimal.
Okay.
Right?
So before we used indirect utility function
Right.
for government problems. For government problem, because indirect utility function they include the solutions of consumers' problems, right?
Right.
And
Right.
here we're trying to solve the individual problem.
Within governmental problem. Right? So we does not do in two steps. There we did in like first step we did the consumer problem and then governmental problem, but governmental problem was formulated based on the kind of indirect utility function that already incorporate in itself the behavioral responses, kind of, you see? So the indirect utility function depend on the prices. In this case, it would be the price on the wage rate.
So basically, it's the same approach, right? or not?
The same goal, right? We want to choose an instrument and account for taxpayer behavior, but mathematically it's a different but equivalent approach, right? So, okay, let me just explain this this second approach one more time, and then move on, and then you will think about this yourself more, so to make sure kind of it's boiled in your head for a little while. So you got the kind of the idea. So here, right, so you don't see any indirect utility function, and we didn't really formulate the we did discuss the consumer problem, but not within that model, right? So, but so you see that social welfare function does not depend on the, it depends just on utility function. How do we know that it's actually incorporate the consumer's behavior? This is done by the fact that we subject our objective function to this second constraint, which is individual first order condition, right? Individual first order condition describe the optimal solution of individual problems. So how individual would choose it behave, right? And so by doing that, we ensure that when government choose its instrument, it accounts for taxpayers' behavior.
Okay, so we just add another constraint to make sure that it is optimal for consumers. Okay.
Yeah, but yeah, okay. So what I want to say about this model is it's a very difficult problem because the government is choosing a function, not a set of parameters, right? And we would not solve this model, right? So we are get familiar with formulation of the model, right? With the idea of the model, and that's it. However, so the intuition behind the optimal income tax is simple. We already discussed it. Optimal income tax trade-off redistribution and efficiency, right? We gain by achieving better distribution, but we lose by having efficiency costs or loss. However, the solution to mirrorless model is complex, and moreover, not much can be said without specifying the distribution of ability and utility function. But the very general result that he showed is that T function is negative at bottom, meaning that we give transfers to poor people, and T function is positive further up, which means that we tax them, and this shows that we have full integration of taxes and transfers. And the and another additional result is that marginal tax rate that they are strictly between 0 and 1 everywhere, meaning that we never have 100% marginal tax rate, right? So we never achieve perfect redistribution. So what we will consider now is we will consider a very, very special case of the Mirrorlessian model. So we will assume a quasi-linear utility function. So capital U is equal little u of x minus z divided by s, right? Quasi-linear function. Why this quasi-linear function is good is because when we calculate the marginal rate of substitution between consumption and income, it would be equal to 1 divided by S multiply the derivative of U of X. And it is decreasing in S, which guarantees us that we have agent monotonicity property. What is it? Agent monotonicity property is when the indifference curves of a high-skill consumer and of a low-skill consumer pass through the same point. The indifference curve of the high-skill consumer is flatter than the indifference curve of the low-skill consumer, meaning that high-skill consumer never earns less income than low-skill consumer. Here's an illustration. S1 represents the low-skill consumer, S2 represents the high-skill consumer. As we just said, the indifference curve for the high-skill consumer is flatter than for the low-skill consumer, meaning that high-skill consumer never earns less than low-skill consumer. Okay, and we also would consider only two consumers. With high level of skill, we'll denote by SH, and with low level of skill, we'll denote by SL. The choice of tax function in this case is equivalent to a choice of two allocations. Allocation XHCH for high skill consumer and allocation XLZL for low skill consumer, right? We only have two persons. So there is so to choose function in this case means to choose just 2 points, right? So the behavior of consumers in this case is described by incentive compatibility constraint. Again, why? Because we just have two consumers, right? What maximizing utility function mean in this case? We just compare 2 points, right? That's it. Therefore, like the first order individual first order condition in this case eventually means that we just need to satisfy an incentive compatibility constraint, meaning that each consumer prefers his own allocation. And we will work under a simplifying assumption that a high-skill consumer can mimic the low-skill consumer, but not vice versa, meaning that incentive compatibility constraint must be binding on the high-skill consumer. This is described by equation 14. So the utility of high-skill consumer when he consumes his own allocation is U of XH minus ZH divided by CH. And this should be equal, right, in general case, greater or equal than the utility of high-skill consumer if he would choose the allocation for the low-skill consumer, which is U of XL minus ZL divided by SH. Right? This is not a typo, this is SH indeed. Okay.
Excuse me.
Yes.
I've got an idea that if the U of a low skill person is higher than the U of high skill person can mimic and pretend to be a low skill person. But I don't understand how from this equation or from this mm, equality we can understand that low skill person can't mimic high skill person.
No, we just prohibit that. Prohibit this by assumption.
Okay, so and the 14th formula is just the result of that
Yes, so
assumption.
this is just this is just incentive compatibility constraint on the assumption that high skill consumer can mimic the low skill consumer, but not vice versa.
Okay.
If this is not the case, that yes, the story would be more complicated.
Okay.
Right. So this is a graph. Just let's skip it. So so then the government maximization. He maximized utilitarian social welfare, meaning it is just equal to the sum of utility of the first and the second consumer, subject to a resource constraint, right? So resource constraint is this word just that consumption equal to income, right? XL plus XH equal to ZL plus ZH. This is exactly the same as say that sum of taxes is equal to 0. Just check this by yourself. And then incentive compatibility constraint is as we just discussed, right, in the previous slide. And then participation constraint is needed here to ensure that utility of low skill consumer is greater or equal than 0. Right, and with what variables do we maximize the government objective function? With XL, ZL, XH, and ZH, right, 4 variables. But we can simplify the calculation by expressing ZL and ZH from the constraints at the function of XL and XH. So to do that, we will first assume that participation constraint is satisfied, right? Later on, we will have to check it, right? Once we solve the problem, the very last step is to check this assumption. But then we will combine revenue constraint with incentive constraints to obtain how ZL can be expressed as a function of XL and XH, and ZH as a function of XL and XH. And I would not read this expression, so just check the calculation by yourself. Then you plug in the ZL and ZH back into the initial objective function, which is equation 15, and obtain that the original maximization problem is equivalent to this equation 21, right? Beta L and beta H is just annotations to simplify the expression. And we now need to maximize only with respect to XL and XH. Right? So we used, right? So an alternative way would be to set up a lone Lagrangian with like 2 constraint or 3 constraint if we don't want to assume that participation constraint is satisfied, and then to deal with that. But we always need to find the most simplest way to solve the problem. And what we can do is to use that approach when we derive the L and ZH from the revenue constraint and incentive constraint, and then plug in it back into the original maximization problem, and then maximize it just with respect to XL and XH. Right? So I wouldn't go into further details here. Now we will take the first order condition, one with respect to XH. So if you do that, you will obtain that the derivative of u at point XH should be equal to 1 divided by CH. And the second first order condition here, the derivative of u at a point XL should be equal to SL plus SH, all this divided by SH multiplied by the difference between 3SL minus SH. Okay, so now we're ready to see what implications follows from this first order condition. First of all, if we calculate marginal rate of substitution for the high skilled person, for that, right, so let us recall, let us go back to this slide where we discuss the assumptions of the model. So marginal rate of substitution is equal to 1 divided by S multiply the derivative of U, right? So now we can plug in what is the derivative of U for, say, high skilled person, and it's equal to just 1 divided by CH. Then we can see immediately that the marginal rate of substitution for between X and Z for high skilled person is equal to 1. But this actually means that the high skilled consumer faces a zero marginal tax rate. Why? Let us recall what the marginal rate of substitution means graphically. It means the slope of the indifference curve. So what does it mean that it's equal to 1? Right? It's basically means that it's have a 40. It's like a 45-degree line, have the same slope, right? But at the optimal point, the indifference curve touches the budget constraint, right? This means that the slope of indifference curve at the point where it touches the budget line is equal to 1. Right? But this means what? That marginal tax rate is 0, right? So the slope of the budget line at that point is parallel, is like correspond to 45 degree, right? Which is interesting, right? So the high skilled consumer faces a 0 marginal tax rate. Note though that this doesn't mean a 0 tax, right? There could be some positive tax, but in such a way that the marginal tax rate is 0. If we now calculate the guys, again over the time, but let us go quickly. So for the low skill consumers, the marginal rate of substitution would be less than 1, meaning that low skill consumer face a positive marginal tax rate. So then conclusion here is that the high skill consumer needs to be encouraged to supply more labor through imposition of a 0 marginal tax rate. Right? So what I can add here is that there was a lot of studies after this famous Mir-Lizin result that was trying to deal with numerical calculations when they consider different utility function and different density functions and calculate what would be the optimal income tax schedule. And those studies found that it's more likely that in this world, in this framework, the optimal income tax schedule would be not progressive, but actually it might be even regressive, right? Or at least the degree of progressivity is not high. But what is critical here is that we trade off the redistribution versus efficiency region. A mental exercise is an alternative story that is proposed by Varian. His idea is that income tax could work as an insurance. Very quickly about this, important assumption in Merlizian model is no export uncertainty, so meaning that once skill type is revealed, agent control income perfectly, and in practice there is considerable ex post uncertainty in incomes, right? You are going to graduate from HSC, but I'm not sure you are very well familiar, kind of sure about your future incomes, right? So in this case, right, when there is this ex post uncertainty, a progressive tax system could provide insurance. We probably do not want 100% insurance for moral hazard reason, but some insurance is desirable if individuals are risk averse. So we could formulate those ideas as the following. So let's say income Z is equal to your effort plus a random noise. Then the government observes only Z, but does not observe your effort and set the tax schedule based on Z. So its maximum utility of individuals is maximization of expected utility that depend on earnings minus tax. And then minus effort, and then the consumer choose his optimal effort. And we can observe that effort is low if tax schedule is very redistributive. This is the same kind of similar problem to the Merlizian case. But government chooses TZ to maximize indirect utility and trade-off insurance versus incentives, right? So here it's not redistribution versus incentive, but insurance versus incentive. And the optimal tax system depends on the parameters similar to those in Merlizian model. However, in this social insurance framework, we can re-evaluate the results for the optimal TOPS marginal tax rate. One would suspect that the marginal tax rate on the highest income person might be quite high. For example, if the only way to become a billionaire is to be lucky, right, there should be very small incentive cost from taxing $1 billion income at a high rate, and there are substantial insurance gains since one can subsidize lots of occurrences of bad luck. So this is the end of the lecture story for today. So we learned the Merlizian model, and we got familiar with this alternative variant model that helps us to better understand the Merlizian model, right? Okay, guys, again, sorry so very much for taking more time. So I'm done. So you can go. Bye-bye.
Excuse me.
Yes.
I've got one question. Could you please one more time remind what is incentive costs?
Incentive cost is that in Merlizian cases that if the tax rate is high, he does not want to work much, right? Or this mean you can try to pretend to be a low-skill individual.
Okay.
And in these settings with variant is it's also depend on your effort, right? It's a very similar idea. So, but if the tax rate is high, but again, this is kind of reduces your incentive to put high effort toward achieving higher income, right? So it's always like reducing your incentive to work. Higher taxes reduce your incentive to work. That is the problem.
Okay, thank you.
Mhm.
Now I got it.
Good.
Goodbye.
Bye
Thank
bye.
you for the lecture.